A warm round of applause, everyone, for Zama.
It is on. All right. Good morning, ladies and gentlemen. Thank you for the introduction, Michael. It's my pleasure to moderate the next panel. I actually haven't seen one of our panelists, so I'm assuming he is here. Oh, there you are. Okay, fabulous. All right, so I'd just like to welcome the panelists up on stage. So let's start off with Kamini Naidoo. She is the Chief Investment Officer at Equilibrium Investment Management. So welcome, Kamini. Nice to see you. And then I'd like to call on Eben Louw, who's a Portfolio Manager at Naviga Solutions. And then we've got Neethling, who's Head of Investments at Morningstar Investment Management, South Africa. Welcome, lady and gents. Nice to see you. All right, so the topic for this session is a look inside a modern portfolio construction toolkit. And I think it's an interesting one because obviously markets have been very dynamic over the years, and I would like to believe portfolio construction does change as well in line with market dynamics changing. So perhaps let's maybe kick off with unpacking what does this modern portfolio toolkit actually really look like? Has it changed at all from previous ones? And if so, what are those changes that have taken place? Kamini, since you're sitting next to me, let me start with you. What are your views on that, please?
Yes. So Zama, thanks. So at Equilibrium, at the core of our portfolio construction is traditional portfolio principles. And what I mean by that is when we build portfolios, we defer to a strategic asset allocation. So what that means is we're looking at the performance of the long-term asset classes and looking at how we can blend those together to achieve our targeted objectives. Where the modern portfolio toolbox comes in is how we can execute on that strategic asset allocation. So in the current environment, we have a lot more tools and we have a lot more levers to execute through those asset classes. And I'm talking about decisions like, should you execute through active or passive or systematic? And more than that, so do you continue to execute through traditional markets, or can you now use the lever that we've got into alternative investment strategies? And we're seeing that play out in our markets with this increased kind of shift towards including hedge funds in portfolios and those kind of tools. Previously, we couldn't invest or execute in as wide a range as we can at the moment. Looking even beyond the execution, though, so in our business, in terms of tactical asset allocation, we now use an AI tool as an input into our tactical asset allocation view. And that makes that part of the portfolio all the more robust in terms of how we make those decisions and to check that we are actually factoring in all aspects. So it does contribute to the completeness. And then we have greater insights as a result of technology that's available now. So what that means is we have better data insights into the portfolio, which means we can respond quicker. We have a much more holistic view of how we're thinking about risk, how we can consider the positioning within the portfolios. So our ability to analyze our portfolios and to respond to the information that we're getting from those portfolios has improved as a result of some of these tools and technologies that we have available. And then maybe the last point just around that data availability is we're also using something like behavioral finance a lot more into the portfolios. So understanding what we need from, what advisors need from us. So what is the typical investor behaviors? How can we construct portfolios taking into account some of those behaviors? And that's as a result of some of the technology and the data that we're getting back from the portfolios.
Thanks for sharing that. I'm actually quite excited just listening to hear you talk about all these aspects, and particularly the usage of the technology side of things. So that sounds very exciting. Okay, awesome. Eben, from your perspective at Naviga?
Yeah, so I think when we think about, the modern toolbox a few things pop up, like ETFs, for example. We've heard about AMCs earlier. We can look at infrastructure, etc. But I think a lot of these things have been around for a while, so it's not necessarily new asset classes. But the important thing is that they've become very accessible now to typical man in the street, to the retail investor, where previously, due to costs or lockups or minimum investments, they weren't accessible. And now we can actually include them for the typical portfolio. So retail investors can have access to all of them, and we have a lot more type of investments at our disposal. And I think that's very, very important. And then maybe another aspect, I think, of the modern toolbox is also using regulations to your advantage. So, things like the offshore allowance increasing, the allowance of private equity in prudential funds, again, allocations to hedge funds. So using these types of regulations and changes in the industry to your advantage, and again, giving that retail client or the typical client access to these alternative types of investments.
Okay, no, that's awesome. We're going to come back to the alternative side of things, because I'd like to actually just unpack that a little bit more. Sean, from a Morningstar perspective?
Sure. Look, so I think from Morningstar's perspective, we are long-term fundamental investors. And the way that we would think about things is not dissimilar to what was mentioned on the previous panel. So really looking at data over time. And obviously in this environment, we have access to different toolkits and more improved data. So I suppose that's more robust than what it was in the past. But the way we would set up would pretty much be looking at asset allocation. And asset allocation, if you look back over time, just what the number shows you, it explains 90% of the variability in terms of portfolio performance and returns. If you look at it between funds, however, it only explains sort of 40% of the returns between different funds. So I think there lies the argument outside of, let's say, long-term or strategic asset allocation to be slightly more opportunistic. And I do think that's where, I suppose, a more modern toolkit does come into play. What I would say from our perspective, though, is we do a lot of work in terms of, let's say, the underlying asset classes. Again, our view is not dissimilar to what was mentioned on the previous panel. So we do think South African equities are particularly well priced, South African bonds, both nominals and linkers. So I think we try to understand those asset classes as well as we can, not only just in terms of, let's say, the performance, but in terms of the variability of that performance. And anything else we look at in an alternative space needs to compete for capital with those, let's say, asset classes. So I think we're seeing very positive things in South Africa and globally in terms of alternatives, and that's a very wide bucket. But I think from Morningstar's perspective, what we try to do is really understand what the drivers and risk of return on those sub-asset classes are before we actually allocate, let's say, client capital to it. Okay, fabulous. So I get the sense that you're all very excited. It's quite clear there are some differences from previous toolkits that you used to utilize in your portfolio construction process. So I think that's great. Okay, so then let's move on to unpacking maybe some of the challenges that you face. You all run model portfolios, and I would like to believe that there are challenges at times in how you execute some of those portfolios on various channels. So let's say you're using a Lisp platform, because I think that's the channel that most of you would be utilizing. Maybe just share some of these challenges, and what have you had to do to overcome some of those challenges in your portfolio construction process. Let me start with you, Eben, for a change.
Yeah, so in terms of restrictions or limitations, I would broadly say, from a list perspective, as you say, we run all our portfolios, or main portion of our business at Naviga's model portfolio, so running off platforms. And essentially the restrictions there can be, I would like to categorize in 3 levels. So firstly, in terms of trading or implementation. So certain platforms, some of them we can implement at a T+2 type trade date, but others only rebalance once a month. So if you're thinking about implementing portfolio switches or asset allocation changes, you have this misalignment between portfolios, because what you want to implement, based on a current quarterly view or a house view, one of your platform-based portfolios are only going to be able to implement that in a month's time. So that makes tactical asset allocation very tough. So there's that portion. Then another side to it is also in terms of fund selection. So a lot of the platforms don't have, they don't list all of the funds that we would like to see. Often we don't have a lot of boutique portfolios, for example. And at Naviga, we like to blend larger managers with boutiques and passive investments. So that often, again, you're faced with a bit of a misalignment problem. So while we look for alternatives to make sure that we standardize the solutions across the LISPs, in some cases you sit with you can't implement your first choice of fund on a certain platform. And I mean, we luckily have some bulk, so we can try pressure the platforms or request funds to be loaded, but it does delay the process, and it is a limitation. And then lastly, I would think from our side now, talking about alternatives, for example, we are pretty active in using hedge funds for our client portfolios. So the structures that LISPs allow hedge funds to be used in. So it's mostly due to legacy and infrastructure problems, but we often encounter problems where certain LISPs can't, firstly, they don't necessarily offer hedge funds, for example, or other alternatives, and you're limited in how you can use those types of investments.
Okay. So then what have you done? So specifically around your last point, using hedge funds, what do you do?
So, first kind of point is to say that we do, the bulk of our assets are on some of the platforms that are more flexible, that we don't have that problem. The second one, I already said, we try as much as possible and engage with these platforms to help them develop, encourage them to develop, try apply a bit of pressure to allow us to make certain changes. But I mean, it is, I think, a problem facing all DFMs. And if you think about kind of the dynamic and portfolios of the future, you need LISPs that are dynamic, flexible, and that are catered for these types of solutions and are efficient through, Naviga being part of efficient, we are actually launching a white label LISP to specifically cater for these types of structures and kind of work around these restrictions.
That's exciting. So you're actually going to be a competitor. Okay. Okay, that should bring some interesting dynamics to the industry. Okay. I'm assuming now it's now public, because now you've announced it in this forum. So now we all know.
It is public, but I'll stop the details across the. I'll stop the details there. Yeah.
Okay. You all heard it first here, right, at the 10X conference. Okay, no, that's exciting times for your business. Okay, Sean, from your perspective, any maybe slightly different challenges from what Eben has shared?
Yeah, sure. So I think just in aggregate, I agree with his views. I would say that the economics of running a platform business is particularly challenging. It's very difficult to sort of run these businesses at scale. So I do agree that I suppose if you look at the number of options that are available, it can be somewhat restricted. But I also think it's incumbent and it's important on allocators to solve those solutions or problems for their clients. So I think what we've tried to do just on the model basis is make sure, again, coming back to, I suppose, our principles in terms of how we invest, making sure that asset allocation is correct, and that we have different mandates for different types of clients. I think that's the most important thing. And then secondly, I think what you try to do is then across the different ranges that we have available for clients. So for certain clients, a fund structure or fund structure would be more appropriate. But I do think within the model structure, we have tried to focus more on that long-term asset allocation. And then to make sure that when we are opportunistic, that we're responding to big moves in markets. So again, it's been 2 years since Reg 28 changed, but that was an opportunity where we saw across our mandates and across our product range to be a lot more opportunistic. But I would say there's very few opportunities where we see an immediate, let's say, call to attention. I would say, for example, the last maybe 2 weeks in China would be one. You want to trade in and out of positions really quickly. But again, getting that more right than wrong consistently over time is not necessarily in the skill set of most allocators.
And Kamini, from an equilibrium perspective, what are some of the challenges that you faced?
So I think largely very similar to what my other panelists have listed. I mean, in terms of availability of funds, it's not just about availability of funds. It's also about availability of fee classes. So at Equilibrium, we operate across 9 platforms, 11 if you include the mancos. And we've been able to get all our funds on there. But where the challenge comes in is we do often negotiate fees where we have bulk and where it makes sense. And you can't always get the negotiated fee classes on the platforms, in which case the client outcomes differ. What you do find is that the bulk of the assets tend to be on those open architecture type platforms that do are more accommodating of including these funds on there. And I mean, we haven't chatted about ETFs, but so in the models, we can invest in ETFs that are daily priced and daily traded. But there's also a limitation there, and more significantly so than with the funds, on which platforms you have those available on. So, I mean, it is a bit of a journey and a bit of a discussion. So at this point, we are engaging with the platforms to try and get those instruments on that would ensure that our portfolios are consistent and more robust.
Okay. So I think what's encouraging about what all three of you have said is you are constantly engaging with the platforms. So I get the sense that the platforms themselves are actually willing to engage on the matter and see how they can, work around these challenges. Okay, so that sounds great. Just out of interest, do any of you have CISs? All three of you have got some form of CIS. Okay. So do you find that the CIS structures provide a little bit more flexibility than your model portfolios? Any of you can answer this question.
Well, yeah, I'll maybe start. So yes, definitely. So firstly, the availability of funds is not a problem there. You don't have to work off the Lisp. It's much easier to negotiate for, or you can actually aggressively negotiate for favorable fee classes from bulking. And of course, you can use things like ETFs freely within that structure. So a lot more flexibility, and of course, you have the tax advantage as well, especially for discretionary investments, where there's no CGT on underlying switches. So yeah, definitely a more flexible vehicle. It does historically come with a higher cost, but there is definitely a place for those structures.
Okay.
So maybe just to add, I think there is a place for both structures, right? And a few years ago, we saw this shift from investors from CIS structures into models, and that was largely driven by a need for greater look-through into the, because that's what models give you, among other things. What we're seeing globally at the moment is a shift back towards CIS funds, which is quite interesting. So it's going to be interesting to see how that travels into our local market, actually.
Sean, let me come to you. So let's move on to portfolio outcomes. We all agree that markets have been quite turbulent. From your perspective, are you finding that clients are still, first of all, is it still possible to achieve those portfolio outcomes that you've set out to achieve? And secondly, are your investors willing to stay the course in this turbulent period?
Sure, Zama, that's a great question. I think, again, the way we look at it at Morningstar is pretty much across different mandates and making sure clients are invested in the right mandate relative to their their risk tolerance and ability to take risk. I would say if you looked at sort of cautious portfolios or low equity portfolios versus, let's say, high equity portfolios, I would say we've been more able to control outcomes in the cautious mandates, so lower risk. I think once you go up, into the, let's call it high equity space, where the underlying drivers of returns tend to be, like was shown on the previous panel, currency, it becomes more difficult to control those different outcomes. And then I think what we've done, for example, in the more cautious mandates is be a bit more deliberate when we see currency driving returns. So what we'll do is when the rand is particularly attractive, we'll basically trade around those positions. Where we'd find in the more aggressive portfolios, again, when it's difficult to disentangle whether the underlying asset or whether the currency is driving those moves, is probably just allow a bit more drift, again, because those clients have the ability to take more risk. So I think the combination that we have in South Africa, unfortunately, bonds and equities tend to be, correlated in the same direction. So I think that makes it really difficult for us. But at the same time, within those different buckets, for example, you can use duration in terms of longer term bonds, and you can bring cash into your portfolio as well. So it's very difficult to control that volatility in absolute terms, but it is possible to soften those drawdowns. I think that's pretty much the playbook that we've seen over the last 18 months, especially in the Reg 28 world. That's a lot wider than what it was previously.
And then, Eben, from your perspective, still talking about portfolio outcomes, but let's maybe take it one step further and actually talk about more the asset allocation side of things and your views. We saw the views from the poll that the previous panel did around, what investors are doing around the offshore exposure. With the changes to Reg 28, in your view, what is the optimal offshore exposure that you should have? Okay, maybe let me rephrase it. Apologies. Let me rephrase the question. In an ideal world, okay, so Reg 28 aside, because you obviously got a restriction, in your view, what is that optimal allocation that you should have to offshore?
I'm going to, instead of giving a straight answer, I'm just going to give a bit of backtrack. We don't typically do tactical asset allocation, so we do strategic longer-term allocations in our portfolios, and we try retain those exposures through the cycle. And what our strategic asset allocation offshore exposures is at the moment is around 35% in our high equity portfolio. So we would tend to drift around that a little bit when currency allows us, for example, or there's a specific opportunity. We also manage some specific mandates where there is a requirement for higher offshore, so then we would go up to the 40% limit. But in general, it's around 35% offshore. I think in terms of research, after 40%, most risk profiles don't need more than 40% offshore exposure. So within a Reg 28 type of portfolio, you have sufficient capacity to use that. But like Sean also said, that comes with a lot of extra volatility, especially if you're allocating to fixed income in an offshore environment, because equity markets, you might be underweight US. We are underweight US, for example, having slightly higher exposure to emerging markets. But if you're underweight offshore equity, you need to park that cash somewhere and you're going to offshore fixed income, the currency plays a much bigger role in that asset allocation course. So 35% is where we feel relatively comfortable in our high equity portfolios, but allowing a bit of drift up to 40%.
Okay, and then you mentioned the currency volatility aspect. How do you manage that? Or hedging?
So in model portfolios, you're a bit restricted in that aspect. We have previously done it on the fund of funds, but hedging it typically only adds a lot of value around the extremes, so that's where we would look at doing it. Again, it's almost more on the fixed income side where you want to hedge because you don't want to have that volatility. And a lot of the local investors actively want that currency exposure over the longer term. The rand typically depreciates, say, 4% over time or per annum over the longer term. Again, you've got a lot of shorter term cycles within that, but for the longer term investors, they want that exposure in the currency. And talking to the previous point as well, we go through quite a lot of detail with investors and advisors in making sure that their timeframes are aligned with their specific exposure to offshore equities, etc., to make sure that those volatilities and market movements that we see from currency or from external shocks, that they can sit through that type of shorter term rotations or moves.
Okay, cool. All right. And then, Kamini, from your perspective, I know you briefly touched on some of these things around incorporating alternative asset classes, especially with your background, coming from a hedge fund space. What are your views on how you incorporate those aspects into your portfolio construction process? And how much are you looking at?
So Zama, maybe if we just take it a step back, when we look at the ability to achieve portfolio outcomes in this current environment, we have seen that we are in a lower return type of environment, and I'm talking more through the cycles. If you look at over the last 7 years, traditional alphas have come under pressure. So we've done a lot of work around what the strategic asset allocation can deliver to the portfolios. And on average, you can get to 70% of your outcome through your strategic asset allocation. So remember, strategic asset allocation is telling you what's on the table, what can the market give you. And we are saying through just what the market can give you, you can get 70% of your outcome. So we need to solve for that extra 30%. And alternative assets or alternative strategies is one of the key ways that you can bridge that gap. And we think about it in how can you use those different risk premia and risk and return sources that you can access through non-traditional markets to help you get to that outcome, okay? In the local environment, that's typically through your hedge fund portfolios, and largely in this environment, it's equity hedge funds and fixed income type strategies, and that's largely where the demand's coming in. So within a Reg 28 portfolio, we maximize that 10% as far as we can, and that's usually we work that out in conjunction with the advisor, and we often see the advisor wants to stop at 10, but on discretionary capital, they'll go slightly higher, right? And there's two parts to that. So one, it's around being able to protect capital through any market volatility that you get in the short term. And the other is being able to maximize your return sources through any environment. So that's the one. In our global portfolios, because we do have global models as well, we do access listed infrastructure. And that talks to your stability in your return profile, the ability to get that inflation protection. So provided that those alternative returns sources are aligned to your targeted outcome, there's definitely a place in enhancing that 70% through accessing those diversified return sources. Maybe just the one comment though. So when we speak about tactical asset allocation, our views are a year out. So we're actually not responding to your short-term volatility. So the news flow around it, the China events, etc. Those would not trigger a tactical asset allocation position from our side. So that's where we rely on some of these diversifying strategies, and alternatives plays a big role in that to dampen some of that volatility and help our clients get to the objective over the longer term.
Okay, and then just in terms of manager selection, do you find that the bigger brands are still the more preferred? Or are clients willing, to explore beyond the bigger brands in general?
So
Okay, I see both of you want. You all want to. Okay, I'm just conscious of time, but yeah, if you can be brief, please, in your response.
Okay, so generally we're not seeing such a big drive for big, but we are seeing a drive for brand. Okay. So clients are looking for strong brands with strong reputation, where they feel that their capital is trusted. So within the portfolios, we have a good mix of big brands as well as your small nimble managers, and both play a role, but it is about reputation and comfort, I think, in the portfolio.
Okay, that makes sense. Eben, from your perspective?
Yeah, I think the same. So the big brands and the reputations and the big resource houses, we still want them there, but we actively combine passive solutions and boutique managers around that. Besides the reputation and the resources, the bigger managers also provide a nice liquidity block that sometimes you encounter problems with in the more boutique managers. So we actively combine them, and just interestingly, over the past few months, our interactions have actually been much more from the advisor's perspective around boutique managers, despite a lot of the boutique managers currently sitting at very high fees due to performance fees. It feels like there's more of an uptake towards boutiques at the moment than what we've seen in the past few years.
Okay, that's positive. And Sean?
Yes, I think the first point I'll make here is, brand or big managers they've earned the right, to basically be part of the client conversation. So I think that's the first thing. From an investing perspective, we're completely agnostic. We pretty much look for the best opportunities to allocate capital on behalf of clients, whether that's a boutique manager or big manager or anything else. I think we're always looking for the best outcomes and best solutions for clients. Yeah.
Okay, cool. Okay, thank you for that. I thought it was going to be a bit of a controversial question, but you seemed very calm answering. Okay, that's great. And then fees is always an issue. I mean, we've seen how fees have been under pressure across the value chain. Do you find that it's a sticky point in your conversations with clients from either your perspective, when you're quoting your fees for the services that you're providing, or even having conversations with potential managers for your portfolios? Kamini, I'm looking at you.
I feel like coming from a hedge fund background, fees are always quite contentious. Yes. But largely the principle is the same, right? So fees have to be commensurate with the value that we're getting. So either to our clients, to the advisor, or for what we are getting from our fund manager. So that's the one point I'd like to make. And the second is just around, at no point should the fee compromise the sustainability of a business. So we don't typically pressure our fund managers to reduce fees. We think we would never want to compromise on sustainability of those businesses. We do think we can negotiate fees based on bulk, and we do that quite successfully, but all within reason and always commensurate with the value that we're getting. And we are trying to stay aligned to our investor base.
Okay, that sounds good. Eben, anything different from your side?
Yeah, no, I would agree. I think you generally have two types of clients. Those clients that are comfortable with the higher fees because they know they're getting the value from it. And then the clients that first, the conversation is first about fees. Now, we've got solutions for both sides of that. So it's positioning it to what the client needs. But I think Kamini made a very good point. We should be cautious of this race to the bottom where you end up compromising the solutions to the client just because they are focused on cutting fees. And at some point, you need to essentially, decide what type of client you want as well.
Okay. And then, Sean, let me come to you, just in terms of transformation, because it's a huge agenda industry-wide. How's your business handling this? Is it an agenda item? If you can just please share your thoughts on that, please.
Yes, I think my first comment there would be at an industry level, I do think it's an extremely important topic, both in terms of demographic and gender diversity, in terms of how it maps out into investment teams and to investments as a whole. I would say that the way we would think about it at Morningstar is we always try to look to attract and retain the best talent. And I think what we look for is cognitive diversity. So people that think different, because that's pretty much putting people in a different room, how you get different outcomes. I do think if you look at, the nature of South Africa, people that come from different backgrounds, or whether you're male or female, the type of thinking that can be introduced from those diverse backgrounds is quite powerful. So I think we look at it more from, let's say, a total perspective in terms of people that are really passionate about wanting to work in the industry. But I do think that we are cognizant, particularly in terms of getting the gender mix right. That's massively important for us. But I think it's something that's going to become more topical, particularly in investment teams where there hasn't maybe been enough transformation, particularly at more senior levels.
Okay. I know we're almost out of time, but I think maybe just one last question to kind of round this panel off. So, this DFM world is very competitive. We see more and more new DFMs coming into the industry. Do you believe there's enough business to go around? And what are some of the key characteristics that you believe are necessary in order to run a sustainable DFM business? Who would like to take that last question? Kamini?
So look, I do think we are probably going to see consolidation in the DFM market. There are quite a number of DFMs out there. I think key things to consider when looking at a DFM is sustainability. So how sustainable is that business? How sustainable is the fee model? At Equilibrium, at 25 basis points, we were only actually profitable after 12 billion. So we've been profitable for the last 5 years, but that's only post 12 billion. So it's important to just make sure that the business is scalable and it's sustainable and set up for scale.
Okay, fabulous. Did you want to say something, Eben?
No, I agree with the comments. I think the DFMs, you'll need to be dynamic and flexible and provide a host of solutions. I think the days of just managing a unit trust portfolio is days are numbered. So there will be consolidation, and for those that continue to thrive, you're going to have to offer a full solution to the end clients.
Okay, fabulous. Thank you so much for sharing all your insights. I hope our audience found that insightful. So thank you.
Thanks so much.